Hi there, this is Robert Wolf with Terra Firma Business and Financial Consultants. You've joined us on our YouTube channel, Asset Coach and Tax Strategist. If you like this video, you like our content, go ahead and give it a thumbs up. Feel free to subscribe if you haven't already, or if you'd like to wait till you've reviewed this content, you've looked at some of our others and subscribed, please go ahead and do that. When you subscribe though, please hit the bell that's grayed out. That way you get notifications when we send out updated information on our channel. Now, let's go ahead and dive into this. In today's video is going to be talking about economic termites. Now, we know what a termite is, right? It's a bug. And it's not just any bug. It's a bug that eats away wood from the inside out, right? So if you think about the foundation of a house, it's going to eat at the wood from inside, and then all of a sudden you find out you have a termite problem, but what has happened? The damage has already been done, right? And so same thing happens economically with certain types of situations that we call termites, economic termites, because you don't know what's usually happening until the damage has already been done. And so our goal is to make you aware of these economic termites that are available. So I'm going to go ahead and minimize my screen. I'm going to keep myself up at the top corner here, and I just want to walk through these economic termites of how we view them and how we see them. Okay, so this comes from our book, Economic Termites, and in here we talk about in 4 of the 5. The 5th one is debt, which we don't talk about in the book. It really deserves its own entire book, but we will talk about it today in this content in this video here. Now, the 4th one is time, inflation, taxes, and then the number 1 cause of economic termites is what we consider laws and regulations. And we'll dive through each of these. But first, let's start with debt. Now, many times we look at debt and we look at it from a consumer perspective. But remember, as a business owner, you have a different way of viewing things. You really should have a different way of viewing things, because at the end of the day, when you look at it, a business is ran separately and differently than an individual. And if you want to know more information about that and contents, check out some of our other videos that discuss and talk about that. But at the end of the day, when we're talking about debt as a business owner, we're utilizing the terminology leverage. Now, could you make the argument they mean the same? You actually could, and it's a lot of times these terms are used interchangeably. But what I find a lot of times is that the business owners or even the wealthy individuals tend to use the term leverage more often than debt. Why? Well, because let's look at the definition. According to Investopia, in which all definitions that we're going to go through in this video is from Investopia, the website. So let's talk about debt. Debt is money borrowed by one party from another, right? Well, that makes sense. Many corporations and individuals use debt as a method of making large purchases that could not be afforded under normal circumstances. Now, I highlight purchases because the term purchases is used versus another term that we'll highlight in a second. In debt-based financial arrangements, the borrowing party gets permission to borrow money under the condition that it must pay back at a later date, usually with interest, right? And that makes sense. Debt can be classified under 4 main categories: secured, unsecured, revolving, and mortgaged. Now, corporations also issue debt in the form of bonds to raise capital. Now, let's talk about this next step here. So over here, leverage. Well, what's the definition of leverage? Well, leverage refers to the use of debt or borrowed funds to amplify returns from an investment or project. Okay? What leverage is saying is that, hey, we're going to use this to enhance this. Okay? And we'll talk about that in a second and what we're referring to with regards to that particular language. Okay, so let's go into this more. Investors use leverage to multiply their buying power in the market. Companies use leverage to finance their assets. Instead of using stock or issuing stocks to raise capital, companies can use debt to invest in business operations in an attempt to increase value shareholder. see the language. Notice the language between these, okay? So debt is making large purchases, okay? It's secured, unsecured, revolving, right? Debt the language is used differently. Now, when we're talking about the use of debt to leverage, there's a difference in our conversation and our purpose. And that's the key that we want to make available here, is understanding our purpose of what we're trying to accomplish here in this particular termite. Okay. Now, if you have debt, personal debt, and you don't have a plan to eliminate or to reduce it, you're in trouble. Okay. And we'll talk about this a little bit later when we talk about some other topics on the economic termites. Now, if you're utilizing debt to enhance, increase, amplify returns, then you're using those dollars to grow. So if you're just using dollars to purchase, so for example, if I'm going to go buy a boat, well, if I'm not using that boat for fishing or chartering or to make other money as an investment, then I'm just buying a boat as debt, and that's liability. It's not an asset. Okay. And so that's a big difference. That's essentially what these two different definitions are talking about. Debt is a liability. Leverage is actually an investment, right? It's an asset. So is what we're discussing here. So now let's talk about time. Now, a lot of times people say, hey, this is the only thing that can't be replaced, right? It's the only commodity that is not replaceable. And that's true, except we have some other things that we need to talk about of what you're referring to time. So time with us as a business, we're referring to the time value of money. Okay, that's what we're talking about here. Now, when we look at the time value of money, it's based on an idea that would help people today than in the future. Okay, what's that mean? Well, $1 today is worth more than money later on. Okay, so you have to have money that earns compound interest, so it's more valuable in the future. But right now, it's more valuable in the present. Okay, so if we're not earning compound interest, if your money is over a period of time is not growing, then it's becoming worth less and less, right? And that's what we want to make sure we focus on when we're talking about that. So when we're also dealing with it, it's a formula of computing time value of money considered a payment now for the future value using interest. The number of compounding periods, okay, that's essentially the definition of time value of money. Now let's look at an economic determination of this is the rule of 72. Now this can go for you or it can go against you. So let me explain that here in a second as I go to the next slide here. Okay. So, sorry. So let's talk about the rule of 72 is basically if you were able to, let me get my pen here, to let's say 72 equals, let's say you were to divide what into 72. Let's say you wanted a rate of return of 10%. Okay. So I want a 10% rate of return. Well, how often will my money double? Is essentially what you do. So you take 72 divided by 10, and that means in 7.2 years, my money should double. So if I have $100,000, that in 7.2 years at 10% rate of return, it should be about $200,000. Okay, that's essentially what the rule of 72 is saying. Now, let's talk about this from another perspective. Let's talk about this from a debt perspective. Okay, so let's say I owe 4%, and I divide that into 72, right? Or inflation is 4%. So we take 72 divided by 4. That means in 18 years, what's going to happen? Well, that means the cost is going to be doubled, right? So we're decreasing value when it comes from debt. Okay, so assets increase, debt decreases. We know that, right? We understand that. That should be basic common knowledge. But I just want to verify and affirm that. So now let's talk about inflation and how inflation has changed over the years. So we can use a cup of coffee, which is a lot of times something that we utilize. Now the type of coffee changes. So let's just talk about drip coffee, okay? And I'm using a Starbucks term, right? I'd like a grande drip, room for cream, okay? So in 1970, it's going to cost a quarter. 1980, 45 cents, 90, 75 cents, 2000, $1, 2010, and then in 2019, $1.59. This is inflation. So the cost of coffee is increasing, right? That is essentially what we're talking about. And so that's what inflation means, is that the same dollar can't buy the same product. Okay? So now let's look at this. Inflation is a devaluation of money. So the Fed, using the rule of 72, the Federal Reserve, has a goal of 2%. That's their goal, of inflation of 2%. So if we were to use the rule of 72, that means that my dollar today, so $1, in 36 years is going to be actually worth what? 50 cents. Okay, it's going to decrease by double. Okay, so what happens in another 36 years after that? Well, then it becomes worth what? A quarter, 25 cents. Okay, and isn't that what we just were talking about with the previous slide? Look at that, right? 25 cents over a period of time and becomes worth less, right? So here's our what? 30 years. Okay, so essentially that's what we were talking about. Okay, now coffee, the inflation of coffee was more than 2% because in 30 years, that dollar, that 25 cents did what? Became 50 cents, it doubled and became $1, right? So that you can tell the inflation of coffee based on that, right? Using the rule of 72. Okay, so let me get rid of my scribbles here and let's go to the next part. So if we start working at age 23, we graduate college, we get a job, and we start working. So in 36 years, so age 59, when we're ready to retire, right? Age 59 and a half is when you start having access to what? Your retirement accounts. Okay, so what happens at that? Well, another 36 years, I'm all of a sudden at 95. Okay, so when we're looking at our dollars, and let's assume 30%. So if we're looking at our dollars and 2%, so the value of our dollar, so if I'm making $100,000 at age 23, my income has to increase, because if it doesn't, by age retirement, what happens? It decreases to 50,000 from a purchasing power, right? So I essentially need what? I don't need 50,000. I need to increase this to what? 200,000 to basically have the same buying power in 36 years. Okay? That's significant. That's pretty significant, isn't it? So that's just 2% Fed goal, right? So if the Fed goal is, or the actual, look at the last 30 years, and it's really been closer to 2.8%, 2.6, 2.8%. So if we round it to 30%, now every 24 years. So start working at age 23, so age 47, okay? Now what happens in another 23 years? Well, guess what? You're 71, or you have now access to your retirement accounts if you don't use them at age 72. You have RMDs that kick in, okay? So you've had 2 periods where your dollar has decreased. So let's look at that. So you have $100,000. So in the first 59, you have to have 200,000 to live your same lifestyle, right? And now all of a sudden you hit age 72 and a half, your cost of living is 400,000, okay? So what do you have to do? You have to decrease your cost of living. Well, how do you do that? Well, sure, you pay off your mortgage. Well, what if you don't pay off your mortgage? Well, you have to figure out what other steps you're going to do. You have to not have any debt, car debt. Your expenses have to go down. Well, what if my expenses because of cost of living goes up? Well, there's the conundrum we're in, right? Now, we haven't taken any taxes into consideration. We're just talking about the valuation of money or the devaluation of money. Our purchasing power is essentially what we're referring to, aren't we? Okay, so now let's look at taxes. Now, taxes as the second economic termite is, what about taxes do most people want? Then we want less taxes, right? Show me that plan. How do I get less taxes? Well, everyone feels that they have a tax problem, right? So when we ask people, and this is kind of comical, when we have conversations with people, one of the first things we ask them is that, do you feel like you're overpaying taxes? What do you think the answer is the majority of the time? Well, yeah. Well, when we ask the next question, well, how much are you paying in taxes? How much are you overpaying taxes? Silence. Most people don't know. So the concept of paying too much in taxes, that's what it is. It's a concept. Everybody feels like that. But in reality, what's that mean? Maybe you're actually paying your fair share. but you just feel like you're overpaying taxes because everyone says they're overpaying taxes, right? So that's what we want to look at is what is that fair share? How does everyone feel is that they have a tax problem? So where or what market can this affect taxes most? Well, business owner market, right? As a business owner, you have the control over your taxation. Whoa, time out. I've never heard that before. How in the world can you say, if I own a business, I have control over my taxation? Well, at the end of the day, when you look at the relationship between you as a business owner and the IRS, your relationship is a partnership. Now, you immediately took that as a negative conversation right there when I said you and the IRS are partners. You're like, yeah, of course, they've got their hand in my pocket all the time. I can't get their hand out of my pocket. In fact, they have both hands in my pocket. In fact, they've got 4 hands, my 2 front pockets and my 2 back pockets, and they're taking everything out of me, right? That's kind of what we feel like as business owners immediately. But here's the situation. The tax code, tax law, is really written for you as a business owner. Whoa. I've never heard that before. Or maybe you've heard that before, but I'm going to share with you this analogy of how we look at that and how we should view that. So the IRS gives you as a business owner tax deductions, right? Your cost of doing business is called an expense. And you get to take that cost, that expense, and deduct it from your revenue. So you're not paying taxes on your top line revenue. You're paying taxes after what? Your expenses. So you get tax deductions. Now you also get tax credits. There's certain things as a business owner that you can change about your business or do that you actually get credits. That's the dollar for dollar credits. You get tax rebates. And there's other tax incentives for you as a business owner. So there's 4 types of tax saving capabilities sprinkled all over the tax code for you as a business owner. Now, you're sitting there saying, why in the world would the IRS do this? Why isn't anybody telling me this? Is probably your first comment. But the IRS does this for this purpose only. Think about it. As your business partner, they want you to save money on taxes. Wait a second. Why in the world do they want me to save money on taxes? Because if you have less cash flow going to taxes, that means you have more money in your business, cash flow, to put into your business. And if you have more cash flow to put in your business, what happens to your business? It starts to grow. And what happens when you as a business owner can't do every task on your own? You have to do what? Hire an employee. There you go. Right there you go. Robert Kiyosaki describes this in the cash flow quadrant. Okay, we have a video on the cash flow quadrant that you can take a look at to help understand what we're talking about if you've never heard of that. As an employee, you don't have the ability to save money on taxes. Sure, you can itemize on your Schedule A, mortgage interest, right? State and local taxes called the SALT tax, charitable deductions, right? And there's a couple other abilities of cost savings on the Schedule A. But at the end of the day, that's pretty much it. Okay, you can contribute to your retirement, your 401k plan, and that will bring some of your income down. Sure. But those dollars will be taxable later on. And if you don't know what that means or how that asset works, check out one of our other videos that talks about qualified plans, which would be a 401k or IRAs, traditional IRAs. So what happens? Well, if you can't tax plan, what do you have to do? Pay taxes. So as a business owner, you're looking for consistent revenue, aren't you? You want clients that are consistent, right? You don't want these big peaks and these big valleys. Well, why would you think the IRS is any different? Why do you think the government's any different, right? They budget every year. Now they break their budget every year, of course, but that's the different conversation. So how do they grade their revenue? By looking at their payroll taxes. That's the revenue. And who gets payroll taxes? W-2. You as the owner pay your share and the W-2 pays their share. And that's very consistent. Okay. Now, if the government spends more than they bring in revenue, what do? They borrow money. Okay. What do you do if you want to do this big marketing campaign or you have to build some widgets and yes, you're going to get the sale, but you don't have enough cash in the bank to buy product or goods to put together your widget to sell. You go to your banker and you borrow money, right? And then when you sell, what happens? You take your sales, you take that cost, you pay off the debt, and you keep your profit. The government's the same way. They're a business. But here's the thing. You're investing in other products to sell. The government's investing in you, the business owner. And your return on that investment is employee tax revenue. Okay? That's the assessment here, and that's the relationship. Okay? And so as long as you understand that, you can understand that the tax code is written for you. Now, you may not have the right tax people or professionals that are helping you with that. That's a different conversation. That's not the IRS's problem. That's your problem. Because at the end of the day, there's only one person who signs your tax forms. You do. Your CPA doesn't sign it. Their information's down there, but you're the only one that signs it. And when you sign it, you tell the IRS, hey, here's my financial statement, my annual financial statement. Here's how we did. Okay? And by my signature, I'm approving these numbers. So at the end of the day, if you feel like you're overpaying in taxes, it's not your tax people's fault. It's your fault. Hate to be kind of blunt about it, but it's your money. So if you want to make changes, you got to make changes. Okay? Just like when you research a car and you want to get the best deal on a car. Why aren't you doing the same thing with your tax people or your attorneys or your other advisors and professionals? Okay? It's no different. All right? At the end of the day, it's your money. So let's dive into here and let's look at the taxes. So tax saved equals a rate of return. So if I'm not paying taxes to the IRS, it's actually I'm keeping money. Why can't you look at that as a rate of return? You absolutely can. It's more cash flow. So when we look at the rule of 72 again, and let's break this down. If I'm in a 24% tax bracket, and I divide that into 72, that means 3 years, what? That I've paid taxes over 3 years. So that means the 4th year, I'm essentially working for free. So when you start working at 23, and in age 59 is when you retire, right? What would we use? The rule of 72 and the other example. So every 4th year, you're working for free. So 9 times you work for free. Now, let's say we're in a 36% tax bracket, which most business owners are in. Because why? They're in a higher income range, right? So if they're in a higher income range at 36%, you fed or state, or just fed, not state, every 2 years. So again, every 3rd year, you're working for free or 18 times during this period of time. Now, if you're upset about this, you only have one decision to make, and that's to change it. How do you change it? Well, you got to find people in your sphere. You got to start looking at tax people, tax professionals to help build your team. The wealthy have teams, right? People blame Trump or Buffett or Bezos or Bloomberg or all these other people that they don't pay enough in taxes. No, they pay a lot in taxes. In fact, you can look at Yahoo Finance a couple weeks ago, posted from ProPublica, talking about Buffett, Bezos, Elon Musk, and Bloomberg, and the amount of taxes they paid. Okay? Now, as a percentage, yeah, it's lower than you and I. But when you look at Elon Musk, he paid $422 million. Well, how many average taxpayers does it take to equal their tax paid to 422 Elon Musk? Sure, the percentages are different, but dollar amounts, at the end of the day, it's all about the dollar, folks, not percentages. Stop talking about percentages. Start looking at the real dollar, okay? And that based on what we've talked about with the rule of 72, it's devaluing, right? So this is pretty important to understand, okay? Now, when we look at laws and regulations, this is our number one termite. This is why it's here at number one, right? We have laws and regulators that are our biggest destroyer of our wealth. Well, what do you mean? Well, we vote these politicians in and look at what they do. They're full-time lawmakers, so what do? They make laws full-time. So from January 2019 to January 2021, they had 16,000 different legislations that they put through over that 2-year period. 16,000. 344 laws enacted. 714 resolutions passed. They got 716 got a vote. They had only 24 that failed and 9 were vetoed. Okay. And then other regulations are 14,000. Ladies and gentlemen, this is ridiculous. And you look at each Congress period, 13,000. This period, 2-year period, 12,000. You keep going, right? And it's getting more and more. Year to date, folks, we're at 6,500. Are you kidding me? Now, how many of these are things that are for our benefit, right? I don't know. It's hard to tell. I've never read 6,500 different legislations that have passed through, right? So let's look at the major enacted tax legislation for the last 20 years, 2010 to 2019, okay? We have Obamacare, right? The Patient Protection Affordable Care Act, right? What'd that do to taxes? Increased it. Tax Relief, Unemployment Insurance Reauthorization, and Job Creation Act. What'd that do? Increase taxes. Temporary payroll cut. Did that cut payrolls? What else was in there that caused taxes to go up, right? Middle class tax relief, American tax relief, tax increase prevention, protection of Americans, consolidated appropriations, tax cuts and job act, bipartisan budget act, and then the fourth continuing appropriations. Look, folks, do you feel like your taxes have gone down over the last 20 years? At the end of the day, you look at your tax form. If your tax form is showing that you're paying more and more in taxes, sure, your tax revenue, your income may be going up, but are you paying more in taxes? And if it feels like it, then you must be, right? And so at the end of the day, that's what we're referring to. That's what we're talking about is that we got to understand, ladies and gentlemen, we got to understand, what are we being affected by? Economic termites. Economic termites. Do you want it to be too late? Because at the end of the day, if you played by the rules, you saved everything, you kept your expenses down, what happens when you retire as a business owner? You gave up your tax benefits. So all your assets that you have currently, you're going to be paying higher taxes because your business is your most efficient tax vehicle right now. Okay? So you got to understand this. This is your money. You're working hard day in, day out. I'm a business owner. I know. We're working our tail off and trying to help each other, trying to provide products and services to improve people's lives. Not every product and service improves people's lives, but the ultimate goal is for that to occur, isn't it? But what happens at the end of the day if you haven't planned appropriately? That's the key here, and that's what we're talking about. So I want to just kind of leave that with you guys. We have some other content that we're going to be providing. This is just under a half hour. So please feel free to comment down below. Share. Again, if you like this video, give me a thumbs up, please. If you want to subscribe to us, go ahead and hit the subscribe button. Hit the little gray bell so you get updated when we send out new content, new information. Now, this information, not everybody's going to be happy with it. That's okay. That's okay. This is our opinion. This is our opinion on how things are. And if you agree with us, agree with us. If you don't, well, then that's fine. Please let us know why. Maybe there's just a little more information and education that needs to occur on both sides. So thanks so much, guys. This is Robert Wolf with Terra Firma Business and Financial Consultants. Thanks so much for joining our YouTube channel, Asset Coach and Tax Strategist. And we look forward to having conversations in the future. All right. Thanks so much. Bye.